locally, where we get to know people personally, and um, that we develop relationships with folks. And PYA really exemplifies what I think is ideal in a strategic partner to all of us in the local startup community. Um, Tom introduced me to Marty Brown when Marty became CEO and president of the firm. We in fact even had a quick update call early this week to talk about the importance of partnerships like that. So I want to emphasize to everyone that PYA truly cares about your success, cares about the relationship that they have in the community with Spark, with Tom and me, and with each one of you as company founders. So rely on them, especially for the detailed stuff that they're going to cover today and even beyond. And when it comes to having that kind of support for your company as you succeed, I hope you develop a real productive relationship with them. They're great guys. So with that, Stephen, Mike, do you have any opening comments, or do you want to just turn it right over to Stephen?
No, I appreciate those comments, John. We certainly appreciate the opportunity to be here with you this morning, and we look forward to this presentation. I think Stephen and I both want this to be more conversational than just a direct presentation where everyone just sits and listens and holds questions until the end. So I think we would welcome you to speak up. I don't know the easiest way to do that on Zoom, but I think if you just want to turn your camera on or unmute yourself, either one, and speak up, let us know if you have a question. But we'll certainly try to have some designated time at the end of the work session to make sure we answer all questions on both presentations. So, but
That's
thanks
great.
again, John, for having us this morning.
You
Stephen,
bet.
it's all yours.
All right, and thanks so much all for the invitation. I'll just echo Mike's sentiments there. Just really honored to be here and to be a part of this with you guys. This is from a tax person, this is really exciting because I'm used to working with very mature companies or partnerships, and just having the opportunity to talk to folks on the other end is really exciting to me. And where I really value kind of the tax services and being able to provide help to others in this tax world. So with that, I will attempt to pull up my presentation. And again, please, if there's questions that come up while I'm presenting or talking, please just unmute, yell at me, and we can stop and have a conversation. I guess just to make sure whoever's seen the presentation, thumbs up. Mike, see it? Okay, good deal. All right. So I am going to be discussing tax planning and filing considerations in a startup environment. I'm going to start with a just high level. I'm not going to get into the tedious nature and all the detail. But just wanted to give a general kind of overview of, tax considerations when it comes to revenue and expense recognition. I want to walk through a taxable income calculation just to demonstrate difference between, book income versus tax income, as well as walk through a tax rate calculation. As you become a more mature company, that tax rate becomes something that potential investors may pay more attention to. But just wanted to walk through that as well. We'll talk about some choice of entity considerations. Some of the key considerations here, as John was alluding to, what might be the best type of entity, depending on your potential funding sources that you're going to want to achieve, as well as a host of other considerations. We'll talk through some tax filing requirements, all the sort of various taxes, and I probably won't hit them all because there's so many of them. But some of the tax filings that as a business, as an entity, you will be, subject to and required to comply with. We'll walk through some cash planning ideas and thoughts, just kind of to demonstrate, taxes sort of interplay with cash flow planning and the such. And then we'll wrap up with some final thoughts. So revenue recognition. Well, I'll first say, unfortunately, the IRS, they like to do things their own way. So generally, they like to come up with rules that is more favorable to themselves to generate more taxable revenue. So they have created their own sort of revenue and expense recognition standards that applies to, all organizations. And a lot of times it does not align, perfectly or strategically with how you might be recording revenue and expenses for, financial reporting purposes. The tax code provides for, a variety or several different types of what I'll call overall accounting methods. And the revenue recognition and expense recognition is a little different depending on what overall accounting method you have decided to utilize. The two most common are a cash method and overall accrual method. And just generally speaking, if you're a cash method taxpayer, you recognize revenue when you receive that cash payment. Everything in the tax code, that's the general rule. There's exceptions to everything and then exceptions to exceptions. I'm not going to get into that at all with you today. If you're an accrual method taxpayer, which I predominantly see, but sorry. As a small business, you may have the opportunity to use a cash method, which is easier and you can more easily manage your cash flow. Which again, I'll talk more about that in a few slides. The general rule for accrual method taxpayer, if somebody owes you the money and you can determine how much they owe you, you generally have to recognize revenue at that point. Thanks to some Tax Cuts and Jobs Act that some of you have probably heard of that came in late 2017, there was an adjustment to this overall rule, which says that, hey, we have these rules, but because recognize revenue, you're going to have to recognize revenue for tax purposes as well.
Stephen, question for you.
Absolutely.
I was CEO of an engineering company, and our average payables were aged about 75 days. So from the time we sent our invoice out to the time we actually cashed a check, it was 75 days. In terms of management reporting, we really like to use accrual because our revenues would be higher. Absolutely. When you report it that way. But we never really like to pay tax on an accrual basis. So isn't there a method where you can become a cash-based taxpayer, but keep your books in an accrual format?
That's absolutely correct. So your overall tax accounting method that we're talking about here, if you are eligible, and there are some rules to be eligible to utilize a cash method for tax purposes. If you meet those rules, you can have accrual for book and cash basis for tax. I think I have this in a couple of slides, but while we're talking about it, if you want to use cash method for tax purposes, you have to be a small business, which is based on your overall gross receipts, which I think right now is in the neighborhood of 30 million or something like that. So if you have cash receipts of about that level or less, and you don't have any corporate owners, you're not allowed to have a corporate owner and use a cash basis. It typically has to be, privately owned, individually owned, or the such. But you're exactly right, John. If you have you meet those two things, you can use cash basis for tax and accrual basis for book. Absolutely. One item I did want to mention, because a lot of startups that I see now are going to be SaaS type businesses, or they're developing, some types of software platforms or apps or something in that nature. And a lot of times, if you have a structure like that, that's your business model, you may be billing your clients in advance. So they're gonna like software that you've developed, for the next 12 months, and they pay you up front for that. Even if you're an accrual method taxpayer, the tax rules would say you have to recognize 100% of that revenue right now. That's just the general rule. If you receive cash, even if you're accrual method, you have to recognize that revenue. There's an exception to that. One of the few exceptions I want to mention for deferred revenue. So this scenario would be an advanced payment for services. So most likely, if you have books are kept on the accrual basis, instead of recognizing all that revenue up front, the GAAP standards are likely going to force them to put up a deferred revenue liability instead of recognizing revenue. And so if that's the scenario for book purposes, tax is allowed to follow that. So if this software license agreement scenario, if book receives the payment up front and defers it, tax can also defer that. That rule is not applicable to every type of service, but the majority of services that I see being generated today fall into this exception. And again, that can be, very valuable, because you don't want to have to, recognize, however much $1,000 of revenue in year one if you can defer it to year two, just under general tax thoughts and plans. Expense recognition. Expense recognition is very similar. Generally, if your tax method is cash basis, you're going to recognize expense when you cut the check, when you pay the check, and you'll recognize the expense if you're an accrual method taxpayer, with this fancy language here, which basically says you've done or somebody has provided services to you, whether it's your employees, they've worked their 2 weeks, so you owe them the money, or if a business, an outside business, is providing services to you, that liability will become fixed and determined with reasonable accuracy. The amount. That's how much is the invoice I'm gonna have to pay. That. I'll talk about the one additional rule for expense recognition that revenue recognition doesn't have is something called economic performance. And that tells you, lays out the timing of the liabilities when they are actually incurred or has occurred. So again, if somebody's providing you services, you owe them the money as the services are being provided. There's some expenses that I have listed there as like payment liabilities. These are generally, workers' comp type claims, or, God forbid, there's some kind of tort liability or something like those items, these types of items, taxes, insurance, those are deductible when you pay them, as opposed to owing them. Again, there can be exceptions to that, but that's a discussion for another day. And to the you get very bored or having trouble going to sleep at night, I've listed some Internal Revenue Code sections here that kind of cover general business expenses. What are the kinds of things I typically can deduct for tax purposes? It's the common things. Generally, it aligns in most part with what you're going to be able to deduct for financial reporting purposes as well. There are obviously some differences, things that you're never allowed to deduct for tax purposes, even if it's deduct purposes. Items like that include meals and entertainment. A portion of meals and entertainment expenses, the IRS says, no, we're only going to let you deduct 50% of meals, and if it's and there's some other expenses like that do have specific limitations. But generally, it's not a question of if I can deduct it, but when I can deduct it for tax purposes.
Hey, Stephen, this is Mike. There's a question that's popped up in the chat. I don't know if you see that or not, but I just thought you might want to take a moment to see if you can address this. I think it's Brandon that's asked. He says, I noticed a new line item on our Autodesk products. It's a software service product with a tax itemization. What has changed for software as a service tax?
This would be my my guess on that. It could be multiple things, but my guess is that it is sales tax related, sales and use tax related. And I apologize, I'll figure out how to bring up my chat. So just a couple of years ago, there was a very high profile tax case in the state of North Dakota. This was Wayfair versus the state of North Dakota. And it actually went all the way up to the Supreme Court. And what this case was all about was a concept of economic presence. So generally, states can't apply sales tax to you if you're not operating in that state, possessing or having some type of physical presence in that state. So your online companies, Wayfair was the plaintiff here, your Amazons and such. The Supreme Court decided that if a state has sales tax rules, you are allowed to apply what is called economic presence standards. So that says, even if I don't have a physical presence there, if I'm providing services there, all I'm doing is dropping off goods there. I'm a software provider. I have customers in a state. My only presence there is the delivery of my service to that client. If a state has sales tax rule that is applicable to services, those become that type of service, that SaaS service, that business model, that revenue going into a state becomes subject to that state's sales tax rules. I hope, again, that is my guess, because we're seeing that a whole lot more as states look to generate revenue to cover their budget shortfalls. This is one area in tax where we're seeing states be really aggressive and begin to apply this sales tax to states.
So Stephen, looks like maybe Brandon's asked a follow-up question here that says, is there a software that keeps track of each state, county sales tax for SaaS product companies that gets complex and hard for small businesses to manage? Example, API for managing the specific tax rates and sales tax.
Yes, there are sales tax software platforms, and I know they're being, even better developed now as a result of these new rules. I can't think of the names off the top of my head. Sales tax isn't my expertise, but Brandon, let me do a little quick research after this, if that is okay. And, I can come back and provide some, examples and listings of some of these sales tax vendors that I believe would be helpful.
And we can get you the email addresses, Stephen, of everybody that's on the call. So
Okay.
We'll get those to you.
Perfect. And Brandon, that is a great question, and one that we're seeing more and more of. And not to beat this to death, but what we're now also starting to see states do this, what I was describing as an economic presence standard. It's only applicable to sales tax. So states aren't allowed to apply those same standards to income tax or franchise tax standards. However, we're seeing states now rewrite their own income tax rules to make this economic presence standard applicable to other types of state tax regimes, whether income, franchise, etc. So I think there's one or two states that have done that now, but that is one big item that we're monitoring to see how the states continue to react to this. But again, states, they're required to balance their budget, and this case that I was describing is one way that states are really looking to be able to generate additional tax revenues. And I have a slide that goes through a whole lot of the different state tax regimes that we'll walk through that here in a few more minutes. Okay, and apologies if this is too basic and elementary, but just wanted to quickly walk through a current taxable income calculation. So on the left-hand side of this slide, it's just, again, a high-level example of, how you would go about determining your taxable income. How much am I going to currently have to pay to the state or federal government or state? And then on the right-hand side, maybe not as important right now, but I wanted to address it just to show some examples of different tax rate expense. So what's your cash tax rate versus your effective tax rate, and some of the differences on those, as again, eventually your investors may look at those items. But on the taxable income, just real quick, so the calculation starts with whatever your book income is. So you have whatever your net income is, however that falls out. That's always your starting point for figuring out, okay, well, what's my taxable income going to be? you see I've got sort of bolded there, pre-tax book income. Again, kind of nerdy. That's a big item for tax people. That's a question. Hey, what's your pre-tax income? All that is your net income plus your income tax expense added back to it. And as I talk about the rates, you'll see how that interplays. This next section in this calculation, you'll see I have termed as permanent items. So on the slide before, I mentioned there are some items that the government has decided, hey, you can't ever deduct this for tax purposes. We're just not going to let you do it. I just listed two common examples here. Meals and entertainment. Again, there's 50% limitations on that, or even 100% limitations on some entertainment expenditures. Officers' life insurance premiums. You're paying the premium for your key officers. IRS says that is something that you can't ever deduct for tax purposes. They force you to add that back to your book income. Then items below that, temporary differences. These items are, you may have heard me say a few minutes ago, it's not a matter of if I can deduct them, it's when can I deduct them for tax purposes. These are some of the common items I see routinely on for just about every organization. Depreciation expense, GAAP, Mike, you can correct me. I hope I don't say this wrong, but I'd say typically is a pro rata approach, whereas for tax purposes, it is the tax methods accelerate depreciation to the front end of an asset life, such that you get bigger deductions up front, but less deductions for the assets on the back end. And also, if you're going to be an asset heavy company, generally we see very favorable tax deductions for depreciation, mainly because of the what you may have heard of as 100% bonus depreciation. So currently, if you're buying computers and the such, for tax purposes, you can deduct 100% of that cost, whereas book is going to likely capitalize and depreciate it, depending on their internal accounting policies. That bonus depreciation is set to sunset, I want to say in 2024 or 2025. So for the next 5 years or so, we'll be able to take care or be able to utilize this bonus depreciation adjustment. And then it will begin to sunset and be fully non-existent in the tax law by 2030. Just wanted to point that out. Another common difference that we see, amortization. Just one such example is startup expenditures. A lot of times we'll be required to capitalize cost incurred to start up an organization. Startup cost. Got another question. Again, book will likely deduct those startup costs. We have to capitalize and amortize those. Let me watch my time and get moving here.
Hey, Stephen, did you see there's another question that's come up in the chat? I think it's about the bonus depreciation you mentioned. It says, was that put in place to boost U.S. domestic manufacturing for equipment purchases?
I'd say yes, that was definitely the main reason. Sort of the history of bonus depreciation. It initially came out in the early 2000s when we were having some really difficult economic pressures, and this was put into place exactly for that reason, to encourage acquisition and construction development of assets. That's absolutely the reason why it was. And it's turned into one of those things that's very, very political in nature now, depending on what side of the fence you stand on. Again, so you take your net income, your tax differences, and you'll come up with a overall taxable income. In this case, you can see your net income was $100. However, you're going to have to pay federal and state taxes on $130, just based on the differences in rules. And in the interest of time, I'm not going to walk through in detail on this rate piece. But the one thing you can see as a result, your current tax expense, your rate is 25%, an overall effective tax rate in this situation of 27.8%. So again, that effective tax rate, typically you want to do what you can to lower that, as that's as a key metric that, again, mature, more public companies pay attention to. All right, choice of entity decisions. Again, you have a number of options to choose from, either in a corporate scenario or more of a partnership or flow through scenario. And I won't read every one of these line items. I guess, John, are these presentations available? Do we make these available to everyone?
Yes, absolutely.
Okay, perfect. So I will just pick a few of these, kind of what I would think more kind of critical items to discuss. I'll come down to equity structure. Here is one of the things I think John was alluding to early on, was what you're looking for future investors. What might they want to invest in, what might be most advantageous or desirable for them to invest. And a lot of times your angel investors or kind of silent investors, they're going to want your entity to be a C corporation in most instances. The reason for that is this equity structure. As a C corporation, you're allowed to provide sort of multiple classes of stock. So you've got common stock. Hey, you issue your normal stock, but they also have an option to sell preferred stock. So if you have a investor who wants to invest in your company, they'll buy preferred stock, and what that means is once you're turning revenue and you're able to distribute money back out to shareholders and investors, they are going to have preferred rights to those future distributions. You're going to have to pay them back first before you pay yourself eventually, essentially. Other structures also allow for that, or entity types, except for S corps. S corps you can only have one class of stock. So in that case, it'd be very difficult for or an investor would hesitate to invest in an S corporation structure. Similarly with partnerships and LLCs. And another one of the primary reasons for that, I will kind of jump down to the tax on income. If you are an S corporation, a partnership, either a general partnership or a limited liability partnership or a LLC, limited liability corporation, the income that's generated in those is taxed at the owner level. So if you're a partner in an LLC, that LLC is not going to be subject to at least federal income tax. All that income is going to flow through on a Schedule K-1 to each partner or owner, and the owner will have to report that income on their individual income tax return. So again, when you're looking for investors and funding, you know, that's not an ideal scenario because they're not going to want to be receiving you know, K-1s every year and reporting income when there may not be any distributions coming out on the back end of it. So that's kind of the two reasons, at least in my mind, you know, why your angel investors, your you know, silent investors really desire a C corporation structure. You know, one of the downfalls, obviously, to a C corp structure is something, you know, I imagine everyone has heard of, familiar with, is a double taxation. So on those distributions that come out of a C corp, you're essentially double taxed because you have to pay that entity level income tax on it. But also, when you get to the point to be able to distribute dividends to your owners, those dividends are going to also be taxable if it's individuals on those individuals' income tax returns. They may have preferential tax rates on it at an individual level, but they're still going to be subject to a second layer of tax on those. And that's typically not the case with, you know, S corps, partnerships, LLCs. Those distributions will impact what we refer to as an owner's basis in that entity. And if you receive a distribution from a partnership, LLC, S corp, it's going to reduce your basis, your ownership tax basis in that entity, such that if you sell it down the road, you may have a little bit bigger gain because your basis is going to be lower, but you don't have that immediate double taxation on those. And I don't know, John, if you have some maybe any additional thoughts on that, but in my perspective, you know, those are some of the primary considerations when you're looking at your entity choices.
From an investor standpoint, I can tell you that nobody likes to chase down K-1s coming out of their little companies that they've invested in. So C corps are definitely the most desirable corporate structure for angels.
Yeah. And in terms of liability, you know, in a C corporation structure, you know, you're limited to your shareholder contributions. So short of, you know, some massive criminal act, you know, it's your liability for accusations or actions brought against the company cannot be any greater than what you have invested in it. And that's generally the case for all of the entity types, with the exception of a general partnership. If you just go out and start up a general partnership, you and a buddy or whatever, if you don't designate as some type of limited liability partnership, you're just a run-of-the-mill partnership, your general partners are jointly and severally liable. So they can come get your house or your personal items, you know, to the extent there are claims asserted against a partnership. So generally speaking, liability, it's limited to your contributions. You're not going to lose more than that unless you're a general partnership type structure where there is the ability to come at your personal assets. Again, just a handful of other items on choice of entity I just wanted to highlight. So fringe benefits, you know, how are they applicable in these different structures? So this is your healthcare plans, your medical plans, whatever other type of benefits you want to provide. Let's say in a corporation structure, C Corp, S Corp, you know, if you're a shareholder officer, you're an owner, but you're also an employee and an officer for the company, you know, you're eligible to participate in all of those. In a partnership or LLC type structure, there's limited participation available under those structures. And it's similarly for retirement benefits. If you're a shareholder officer, you can be part of the 401k plan of the company. Again, there's certain more limits on S corporations, but generally they fall in line with the C corporation structure. And again, there's the partnerships, limited liability corporations are further limited on what they are allowed to offer their shareholder members or shareholder partners. Reasonable compensation limits. Just real quickly, what this alludes to is a concept of one, hey, I'm a shareholder officer, you know, I'm only gonna, you know, pay myself $1 and take income in some other fashion because I don't want to pay a whole lot of self-employment tax, or I don't want to have to pay payroll tax. You know, to the extent, you know, an officer's compensation is either too low or appears to be too high, the IRS can come in and through valuation analysis and studies, you know, hey, determine, you know, the comp that you're currently paying is not reasonable, and because of that, you don't get a tax deduction for it. I don't personally see that a lot in practice, but I have seen it some, and just something to be cognizant about. And then again, payroll taxes, I just alluded to that. You know, shareholders are subject to, you know, payroll taxes. So if you're a C Corp or an S Corp, you know, you're gonna get a paycheck just like we do, and it's gonna have, you know, payroll taxes subtracted automatically from that. Under a corporation type structure, as an employee, we're only paying half of that. So we're paying like 7.5% or something of the total payroll taxes due. Under a partnership and LLC structure, you are going to be subject to the full almost 15% of self-employment taxes. So when that income flows through to you on your K-1 and you report it on your individual income tax return, you're going to have to pay roughly a full 15% self-employment tax on that, in addition to your federal income tax obligations. There's some above the line type deductions you get for that, so it nets out to maybe a smaller percentage than 15%. But generally speaking, if you're a partnership or LLC, you have to pay that full amount of self-employment tax. Again, really quickly, just filing considerations. You know, both federal, state, and even certain locales have income tax returns. They're going to be due every year. They're going to be due either 2.5 or 3.5 months after the end of that tax year. I'll caution you there that these jurisdictions want their money earlier than that. So the to the extent you're going to be a taxpayer, you're going to have a tax liability. You know, these jurisdictions require you to pay those taxes throughout the applicable year with quarterly estimated payments. So that's just something to be mindful of from a cash flow perspective, that, you know, if you're making money, you're going to have to make some sort of quarterly payments to the IRS and probably a state jurisdiction that you're working in. And then I'll just highlight, you know, employment payroll taxes we've talked some about. You're going to have, you know, filings, and admittedly those can be headaches, because those can be, depending on your size, can be monthly filings, quarterly filings, etc. Sales and use taxes, you know, property taxes, you know, obviously real property taxes, but also a lot of state and local governments have tangible property taxes. So on your tangible fixed assets, you're likely going to be subject to some type of tangible property tax. In lieu of income taxes, some states have adopted a gross receipts tax, and we're seeing more states start to adopt this type of methodology. Ohio and Washington are two states that come to mind right off. So instead of applying an income tax, where you go through and you determine your taxable income and you pay some percentage of that, they're going straight to your top line and taxing your gross receipts in that state, applying a percentage to that. And those are, some are due, you know, I see some that are, again, monthly, quarterly, some are still annual filings. But that is a type of tax methodology that is becoming more and more commonplace in place of an income tax. And franchise and privilege taxes, a lot of states will charge you for the privilege of providing services or goods in their state. Some states call this a franchise tax, some call this a privilege tax. But, you know, those are just 5 or 6 of the, you know, routine taxes that really, no matter what type of entity structure you may determine is appropriate, these are all going to be applicable to you. And again, there's others. You're going to have annual business registration fees and filings, and it's a lengthy list, but these are common ones that definitely, no matter what entity you are, is going to be applicable. Quickly, because I know Mike wants to talk desperately about his respective financial statements. I'll try to wrap through here. This first item here, qualified small business stock, I did want to touch on that. So if you incorporate as a C corporation and you qualify as a small business under this section of the tax code, you can qualify for a 100% tax exemption on the sale of that stock. As you can see there, to be a qualified small business, so 50 million of gross assets before and after your initial stock issuance. You know, to be eligible for that exemption referral, you must have acquired the stock at the original issuance. So when you originally set up that company and you issue that initial stock, those would be the individuals who this would be applicable for. And you have to meet active business requirements. So if you're actively running a business, you would meet that requirement. So if you are a qualified small business and you hold qualified small business stock, again, if you hold that for 5 years, it's 100% tax-free. If you sell it within that 5-year period, you can get a tax deferral if you take those proceeds and invest in another qualified small business. You can essentially apply that gain that you would have been forced to recognize and add that to your basis of your new investment. So it'll eventually get taxed again, or potentially get taxed when you sell the stock of that next business. Private company stock option plans. So again, this is something I wanted to mention. It's a good way to compensate, key employees. If you don't have, a lot of cash, you can say, hey, I'll give you stock in the company. I'll give you equity compensation. If you're a C Corp, there's specific rules that mandate if you're going to have a stock option plan in your company, you are required to obtain a fair market valuation of your stock to set that exercise price. So that's just something to be thoughtful of. And, also the potential dilution to other stockholders. It can dilute the other stockholders' value that they hold in the entity. If you're an LLC, these same rules don't apply. You can offer profits interest that essentially operate the same way as a stock option plan, but you don't have to get a valuation for it. There's no rules making you get a valuation. We've touched a little bit of this kind of throughout the presentation. Again, just wanted to highlight, the consideration. If you're a cash basis taxpayer, for tax purposes, you can, through proper planning projections, you can more effectively manage kind of your taxable income at the end of the year. So how much is my tax bill actually going to be? And depending on your your cash positions, you may have excess cash. So you may want to prepay expenses, reduce your current tax liability, or you can use bonus payments to pay out or defer. Again, kind of depending on your cash position and the potential deferral of the tax impact on those. I think I've already touched on those IRS limits. If you're an accrual basis taxpayer, it's more difficult to manage that. There's some kind of fancy ways to try to use tax accounting methods to, defer revenue, accelerate expenses, but it's not as much in your control as if you're a tax basis taxpayer. The list here, these are some tax credits that are available, research and development tax credits. To the extent you're developing software or designing processes, things of that nature, you can qualify for R&D expense, R&D credits. Others, energy efficiency credits. There's a lot of credits out there for that. If you're working in, or if you have operations in distressed markets, empowerment zone or new markets, again, these are credits to incentivize companies or businesses to organize in these distressed or more distressed areas. And there's also disaster zone credits available. So just some final thoughts before I hand it over to Mike. Carefully consider your entity structure, what you decide on. As you can see, there's many tax implications. Also, dependent potential equity infusion in your company. And then also, if you think long term, hey, what's my exit plan going to be here? What's my exit strategy going to be on the back end? Your entity structure is very key. And just also want to point out, just consider tax throughout the year. Don't wait until the end of the year. And if make sure you pay and file on time, because again, IRS will assess costly interest and penalties on you. And I'll say, lastly, and maybe most importantly, is find a tax advisor who you can ask these questions to and who can help you on the front end. Somebody that you're comfortable with, you can trust. Obviously we're available to help, and would love to help you on your adventure. But one of the most important things is, whatever you do, consider tax early on in almost every decision that you're going to make, whether it's entity structure, transactions, what have you, because there can be unpleasant circumstances which are almost impossible to undo from a tax perspective if those aren't considered. So with that, I'm not sure, are there any other questions in the chat?
Stephen, you did have one other question in the chat. I'll read it. It says, when I worked at an oil refinery, we had our oil stored in a free trade zone. Is the tangible property tax the reason why free trade zones exist? Typically ports. Are there any inland free trade zones?
What I think of when I hear the free trade zones, yes, the answer is yes. I know where I live in Nashville, we have a very large Japanese-based car manufacturer, Nissan. Nissan is here, and quick story. I grew up in Winchester, and when Nissan made the decision to come to Tennessee many years ago, they ended up building an engine plant in the Winchester area, and they bought our actual land that we lived on, our house was on, so we had to move it. But that whole area that they bought is qualified as a free trade zone, and that has to do with tangible property taxes, but also it gets into the whole host of tariffs, treaties between the countries, what those zones are applicable. It's much more than just the tangible property taxes. But yeah, those can be inland or port based.
All right, Stephen, I don't see any other questions. So
I've got one more question for Stephen.
Yes, sir.
For revenue classification, tax revenue classification, right now, so we're pre-revenue. I'm the only person who's put any money in outside of Grant, so I'm the only person on the cap table. Occasionally, I have to pay an expense out of pocket because we won't have a grant that can pay for certain things. Do I need to be classifying what I'm paying as taxable revenue if I'm not issuing more shares to myself? Because it won't change my percentage. More shares might be issued, but I'm staying at 100%.
You're 100%. So yeah, I mean, I think in that case, that's the scenario you would be in. I would not think of that as a taxable revenue to you, but more of a contribution from you into the company. So it would increase your holdings. But yeah, to your point, you're already 100%. You would end up with more shares. But it would not be like a tax revenue to you.
So every time I pay an expense out of pocket, I should be issuing myself another share?
No.
Okay.
No. I mean, practically speaking, no. I think we want to be practical here. No, that's no. And then, ideally, once you start generating and have the other cash, obviously you'll have the cash just coming right out of the entity. But technically speaking, yes, when you're technically contributing to the corporation, so you should be, increasing your number of shares that you hold. You own 100%. I would not consider that a huge risk by you not doing that.
Okay.
To the extent you had other shareholders, it might be a different conversation. But currently, I think you're fine.
Okay, cool. Thanks, Stephen.
Mm-hmm.
I have a quick question about the qualified small business stock.
Mm-hmm.
So I think I might have missed the beginning of that conversation, but do you mind to go back to that? So is that for a C Corp?
That is for a C corporation. That's right.
Okay,
right.
So then how would this work? This is like if you, can this be an incentive option for new employees, like as an alternative to stock options, or no?
No, because the stock that this is applicable to has
Yeah.
to be issued at the original issuance.
Okay, so this is just for founders.
That's exactly right. This is a benefit. Yes, that's
So in this scenario, if founders sell, like if there is an exit opportunity and a founder sells their shares, but they have held on to them for 5 years, they're not taxed, or they're just taxed at the time of sale, is what you're saying?
no. It is taxed to tax-free exchange. So there's no tax applied to the holder of it. You've held it for 5 years and you meet the qualifying conditions. I mean, in the IRS put this in place many years ago, in as a way to kind of infuse the economy, encourage startup, small business, the investment in kind of similar to we were talking about maybe bonus depreciation or something earlier. But this is something they put in the tax law to encourage, the creation and investment in these qualified small businesses. And so, yeah, if you're a founder and your business meets these criteria, that sale, if you've held it for 5 years, the gain on that would be tax-free. Now, I will say, if you think that this is applicable, I would definitely get a tax advisor just to look at it to confirm.
Right.
But yeah, it's tax-free.
Interesting. Okay, thank you.
Stephen, thank you. Great stuff.
Absolutely.
Mike, you want to jump in?
Sure. Yeah, let me share my screen here quickly.
Apologies,
and I think
Mike,
while you're
leave you a
doing
lot of
that,
time.
while you're doing that, why don't we comment on time? I think we originally scheduled this to end at 10:30. There's been some flexibility in the way we've set up the ending point for our workshop. So Mike, if you need to run over, we'll run over. Some of our folks may need to drop off to go meet other commitments, but let's cover what we can, and if we need to follow up, we will.
Sure, John. Well, this is a very scalable part of the presentation, so I think we can make it fit within 20 minutes. But if there are questions that need to make us go longer than that, I don't mind to stay on with anyone that's still on that has questions. So I'm sure Stephen can hang around to answer any more tax questions during that time as well. But yeah, so I'm just going to jump right in. And actually, before we talk about prospective financial statements, I'm going to spend just a few minutes to kind of revisit a couple of concepts just on historical financial statements, because I think it'll set the stage for our discussion of prospective financial statements just a bit easier. And by the way, when we talk about really any financial statements, be them historical or prospective, I want to mention that, we could be talking about anything from back of the napkin type financial statements to all the way to the other end of the spectrum, which would be generally accepted accounting principles, compliant financial statements. And so when I say anything in between, there are several in betweens there. Stephen's mentioned a couple of them. But if you think about back of the napkin, you can work your way up to cash basis financial statements, just that, you're just keeping yourself, maybe even in Excel or something like that. You can also have what's called modified cash basis financial reporting. And really, it's a fancy term, just meaning there's probably some component of accrual going on, but it's not full accrual. So therefore, it's modified cash basis, meaning it's more closely resembles cash than it does accrual. You can also have a set of financial statements called modified accrual basis financial statements, which that's, again, a fancy term, meaning that it's closer to accrual than it is cash basis, but there's still some element of cash basis financial statements. And then you can have full accrual financial statements. And full accrual is not necessarily synonymous with GAAP basis, although a GAAP basis set of financial statements would have to include a full accrual set of financial statements, but there'd be some specific accounting methods that would have to be used in that full accrual concept. So with that kind of with that concept out there, that spectrum, if you will, we're going to be talking about prospective financial statements today from the standpoint of more sophisticated investors that would be arguably looking for a GAAP basis, generally accepted accounting principles, set of financial statements and prospective financial statements. So again, let's talk about just for a moment historical financial reporting. So a balance sheet. When I think of a balance sheet, I think of a snapshot in time. So again, it's just as of a date. If your year end, your calendar year end is December 31st for your company, then your balance sheet for your year end cutoff is going to be a snapshot in time of what were your assets, liabilities, equity as of that date. So when we also talk about a balance sheet, keep in mind there's kind of a formula that's used here. It's assets equal liabilities plus equity, right? So that's kind of the formula. So whenever you lay out sometimes you see a balance sheet presented where assets are on the left side of the page and liabilities and equity are on the right side of the page, and the totals of those components balance, right? That's the whole idea behind a balance sheet. So it's all based on this double entry accounting system that's been created, where essentially every transaction that occurs has a debit and a credit to it. So that's the whole idea behind a balance sheet. Anytime there's a transaction, there's an equal offsetting entry, a debit and a credit that keeps everything in balance. So if we understand that about a historical balance sheet, that'll help us as we think about prospective financial statements. Other things to be aware of when we're talking about a full accrual or GAAP basis, even set of financial statements, there are different categories, right? So we have current assets. You may know this, but all that really means when we call something a current asset, it means we expect that asset to be converted to cash in less than 12 months. If it's a non-current asset, then it means it's going to be converted to cash in some time greater than 12 months to infinity, right? It could be a type of a non-current asset, like an intangible asset that may never be necessarily converted to cash. So that's the difference there. Same with liabilities. We may have a current liability, meaning we intend to make a payment likely to a third party within the next 12 months. So therefore we classify it as current, versus a long-term liability means we don't have to make that payment to someone until some period after 12 months. And then of course we have the component of equity. So let's talk about equity for a moment. We know that we can kind of reverse the equation we talked about a moment ago, where we said assets equals liabilities plus equity. We can say assets minus liabilities equals our equity. So equity is essentially the net worth of your organization. So when we think about how can equity be impacted, and Stephen talked about the different types of organizational structures. And so the types of transactions that you have going through your equity account likely is going to be contingent upon the equity structure. So for example, if you chose a C corporation, you would likely see some initial capital contributions, right? People purchasing that common stock or purchasing that preferred stock that Stephen talked about that's going to increase equity. In the case of a C corporation, there may be dividends that are being paid. So then you're going to have a reduction to equity for those dividends that are being paid over time. And then the other most common type of transaction you have going into your equity account is going to be the accumulation of net income. So every year when you close out your year, that net income from that year is going to roll over into your balance sheet as a component of equity. That's kind of called the closing out process, if you will, of income for the year. That's going to increase your retained earnings or increase your equity. So just want to kind of get those concepts down. But if you think in terms of kind of personal finance, the equity of an organization is very comparable to your personal net worth, if you will. You personally own assets, you personally have liabilities. The difference between those two would be your net worth as an individual, very comparable to the equity of the organization. So if we then talk about an income statement, so if a balance sheet is a snapshot in time, an income statement is not a snapshot in time. An income statement is an accumulation of activity over a period of time. That is typically over the course of a year, but it could be less than a year. It's very common to see income statements presented for a quarter or a monthly income statement. So you just have to tell the person when you're presenting an income statement. With a balance sheet, you're telling them the balance sheet is as of this date. You would never say with a balance sheet, this is my balance sheet for a 12-month period, that doesn't make sense. A balance sheet is as of, again, a snapshot in time versus an income statement. You have to say, this is over the most recent quarter, or this is my most recent month income statement, or this is my year-to-date income statement. I've given you a very simplistic layout of an income statement here, but you basically typically start with your sales or revenue. You may subtract off your cost of goods sold, and it's pretty common to see in different types of organizations this approach where you then present sort of your gross profit before you get to then subtracting any selling, general, or administrative expenses, and then also adding in any other income that's not related to direct sales or revenue. Could be something like investment income or something like that, interest on investments, less any taxes, what Stephen just talked about, to come down to a net income. And then Stephen talked about kind of a net income before taxes. So you go back up to that subtotal if you added back the net income to your taxes there. So that's kind of a general layout of what an income statement would look like. And then another statement that's commonly used especially in GAAP, generally accepted accounting principle reporting, is a cash flow statement. And think of a cash flow statement as just it's basically a way to break down the change in cash from the beginning of a period to the end of a period. And you typically present those changes in three different main categories: cash flows from operating activities, cash flows from investment activities, and cash flows from financing activities. So again, general accepting accounting principles prescribes where each of those activities has to go there. And it's pretty common in a prospective set of financial statements looking into the future to also present future cash flow statements.
Question, Mike.
Yes.
Cash flows from investment activities. Are those activities investments made by the company or made in the company?
Both. Yeah, could be both, John. So yeah, good question. So I thought it might be helpful, and we'll cover this very quickly, just to know that there are these standard setting organizations out there, the FASB, the Financial Accounting Standards Boards. They're the ones that actually create generally accepted accounting principles. So no one else has the authority to do that. Just FASB can create, and they issue these accounting standard updates that basically get codified. And that is, so when someone says they're reporting in accordance with generally accepted accounting principles, that means they're following all the accounting standard updates that have been issued since the beginning of time by FASB. The American Institute of Certified Public Accountants, something called the AICPA, they're a standard setting body for the CPA profession, but really they do more about telling me in my role as a CPA and as an auditor how I can do things like audit, review, and compile financial statements. They're not actually setting GAAP. Sometimes GAAP is industry neutral, and so there's not specific guidance for a SaaS company, for example, like we were talking about earlier, software as a service versus maybe a healthcare company versus a bank versus a technology company. The AICPA will step in and they'll create industry committees and provide interpretive guidance to say, if you're in this type of industry, here's how you apply this FASB statement. And so it doesn't mean it's authoritative GAAP, but it does mean it's guidance that if you're in a certain industry, you can look to and see how to apply that. You have the Security and Exchange Commission of the SEC that creates sometimes special rules just for SEC registrant companies. So if you're going to go public, you would have to look to SEC companies. And then there's the Office of Management and Budget, the OMB. The reason I bring this up is if you receive and expend over $750,000 of federal grant money in a single year, then you're going to trigger what's called a special audit that's a single audit that has to be done in accordance with this OMB guidance. And so that's just important to be aware that that exists. And again, if you have questions on that we don't have time to dive into today, feel free to let me know and we could talk more about single audits offline. So I'm going to skip over these slides. I just kind of gave you a quick update on several of these. One thing I did want to point out when I talked about the AICPA, there are different levels of assurance that go along with historical and prospective financial statements. We've all heard of audits, and audit is a term that gets used loosely, but in the context of a financial statement audit, an audit is essentially the highest level of assurance that you can have on a set of financial statements, but you can only audit a historical set of financial statements. You couldn't audit a prospective set of financial statements because those events haven't occurred yet, just what someone thinks is going to happen in the future. A review is less in scope than an audit, therefore lower level of assurance. Again, you can only review a historical set of financial statements where you're just making inquiries and performing analytical procedures. But then you get into compilations and preparations, and you can compile or you can prepare a historical or prospective set of financial statements. But both of these require some level of CPA involvement if you're going to tell a third party that they've been compiled or prepared by a CPA. So again, you could scratch out a projection or a forecast on the back of a napkin and hand it to somebody, but if you're telling them that it has CPA involvement behind it, it's going to need to be compiled or prepared in accordance with AICPA standards. Okay, I'm going to skip over these SEC and OMB slides because I've really covered that information with you. So with all that context, let's talk for a few minutes now about prospective financial statements. So prospective is simply that. It's a forward-looking financial statements. Investors and even lenders are going to want to see sometimes if they're talking about loaning you money, or if somebody's talking about investing, they're going to want to see what you think your company is going to look like in the next 1 to 5 years. So the AICPA has really created two main types of prospective financial statements, forecast and projections. And we're going to talk about what's the difference between these two. So bear with me and allow me to read to you for just a moment. Forecast. These are prospective financial statements that present to the best of the responsible party's knowledge and belief an entity's expected financial position, results of operations, and cash flows. A financial forecast is based on the responsible party's assumptions, reflecting conditions it expects to exist and the course of action it expects to take. A financial forecast may be expressed in specific monetary amounts as a single point estimate of forecasted results or as a range, where the responsible party selects key assumptions to form a range within which it reasonably expects, to the best of its knowledge and belief, the item or items subject to the assumptions to actually fall. So this is the AICPA's definition of a forecast. If a forecast contains a range, the range is not selected in a biased or misleading manner. For example, a range in which one end is significantly less expected than the other. So that's a forecast. I'm going to tell you what the difference is here, but let's see if we can pick up on it just as we read through here. A projection. Prospective financial statements that present to the best of the responsible party's knowledge and belief, given one or more hypothetical assumptions, and an entity's expected financial position, results of operations, and cash flows. A financial projection is sometimes prepared to present one or more hypothetical courses of action for evaluation, as in response to a question that begins, for instance, what would happen if? A financial projection is based on the responsible party's assumptions, reflecting conditions it expects would exist and the course of action it expects would be taken, given one or more hypothetical assumptions. A projection, like a forecast, may contain a range. So if we contrast forecasts with projections, and here I'm not going to read to you, I'm just going to kind of say this in my own words, but a forecast really represents, to your belief as the owner, the founder of this organization, this is truly what you believe is going to happen. That's going to be your forecast. But let's say you have an investor that you're talking to and you're going through some hypothetical what if scenarios. Well, what if this? What if we did that? What if this? You may want to have multiple scenarios of what your company could look like in the next 1 to 5 years. So therefore, a projection would be more appropriate in those circumstances versus if you're wanting to maybe chart one path or a fairly tight range of what you think is going to happen, a forecast would be more appropriate in those circumstances. So hopefully that makes sense. There are three main types of assumptions: those that are expected to happen, those that are hypothetical, so used to portray what if scenarios in a projection, and those that would be expected to occur if the hypothetical assumption occurred. So therefore, again, in a projection. So really the first type of assumption, those that are expected to happen, that would correlate to a forecast. The other two would correlate more to a projection. So all significant assumptions in a forecast are expected to occur, although that does not mean that the responsible party is certain of the results, because none of us have a crystal ball. So even though it may be a forecast and you think this is what I expect to occur, no one's going to hold you completely responsible. An investor should not if it's a forecast, because you're just saying, to the best of my belief, this is what I think is going to occur. So what I've put at the end here, and I'm not going to cover this in detail, but I am going to wrap up since we're almost at 10:30 and just say I've given you in this presentation an illustrative example of a set of prospective financial statements. And this is not anything that I created. It's just one that I had access to. But it will give you just kind of the layout, and I'll just, as I'm talking, I'll click through the pages. It'll give you the idea of what a layout of a set of prospective financial statements look like. And even once you get beyond just the balance sheet and income statement, you'll notice there are a series of footnotes that go along with this. And this is really helpful for a potential investor to kind of peer beyond the numbers and see more narrative information and some narrative schedules that support what you were thinking in designing. And I'm going to go quickly here to this page, the Schedule F. So if you looked at the revenue, this company was projecting revenue to increase significantly over a 5-year period of time. You can see here, this is a little more information in a footnote that's giving them some statistics, if you will, projected statistics of what they expect to happen that's going to be the drivers behind that revenue increase. So hopefully this will be helpful for you to see an example of what a hypothetical company may have created for a set of prospective financial statements. John shared with me a tool recently that he has access to, and I believe you have access to, that I believe looks like could be a good starting point as well. It's kind of a Excel type of a format that could help you build a set of prospective financial statements. But as Stephen said, if you find yourself needing to put together a set of prospective financial statements and you're having trouble knowing where to begin or would like some CPA involvement, just let us know. We'll either try to help you or point you in the right direction. So, but John, thanks for allowing us to have this time today with everybody, and hope this has been helpful. And Stephen, I'll be glad to hang around on the Zoom for a few minutes, and you can also email us afterwards, and we'll try to follow up on any questions.
Mike, that's tremendous. Thank you very much. Super helpful. Stephen, your materials as well. So let's look in the chat. We lost Don, and Tabitha notes that the session is being recorded, which I think we all got a notice of. So if anyone wants to refer back to a specific part, they sure can. And Mike and Stephen, you'll share your slides with us all?
Yes, John, I think we emailed those to you, but if we need to get those distributed out in any other way, just let us know. We can send those to Tabitha or whatever the best way to do that is.
That's great. That's great. So any other questions?
Hey, real quick, I think I do see one hopping up.
Yeah. Hey, I started to type this out. It's probably just easier to ask not in the chat, but I did have a quick question regarding, so I've been working on some financial statements recently. And so this is probably a question that applies to most everyone on here, right? So most of us are working off of grants right now. I don't know if anyone is actually like selling what their end product would be, but you could argue, right, grants are sort of the sale of our services more or less in R&D. So I guess my question is, should grant income go into like the top part of your balance sheet, or does that go under the like other income part?
Yeah, it's a really good question. Is that Anna that's asking? Is that?
Yeah, hi Mike.
That's a really good question, Anna. So and it may be that the format of your income statement as a company would evolve as your company grows and matures. But I think that in the startup stage, it would be appropriate to show that in kind of the top part of your income statement, and then show some of the grant related expenses below that. And then, as things evolve and your other types of revenue become more significant, it may be that the grant revenue becomes a less significant part of your overall revenue. And at some point that may drop down from the top part of your income statement into a lower part of your income statement, and that's okay, you know, for that
Okay.
to happen over time. So.
Okay. So then, I guess along that line, would sort of cost of goods sold, like direct costs applied to the grant? So like direct cost of materials or direct time on the grant, things like that. Should that go into like direct cost of goods sold? Or should we basically just throw everything? Because, you know, grant accounting and normal accounting are unfortunately very different, is what I've learned over the last year. So, you know, there's a big difference between direct and indirect in the grant world. Is that how we could kind of distinguish that on financial statements?
It is, and and you may even want to move away from the actual terms, you know, cost of goods sold, perhaps, but maybe just have grant income and then grant related expenses, and then maybe come down to a subtotal of net grant income or something like that. And there's a fair amount of flexibility clearly in some of those descriptors that can be used for line items. But if you have any follow-up questions after today on that, I'm happy to chat offline about that, or if anybody else has similar questions. But yeah, just quickly, you've got the flexibility to do that, Anna.
Okay, cool. Thank you.
Yeah.
One thing, Mike and Stephen, for your benefit, that I have reminded all of our Sparks of, it actually is a standard part of the mantra that I deliver to all of our startups here in Knoxville, certainly, and that is the notion of adding value. And I want to make sure that the teaching moment that you went through connects to that, and that's the time at the end of your fiscal period, typically the end of your calendar year, when you look at your income statement and your balance sheet and your CPA or your CFO sitting next to you, and you say, that's it, this is our set, and you're able to actually transfer that net income line on your balance or on your income statement over to the shareholder equity portion of the balance sheet. That is a huge victory for your company, and at a time when I always used to breathe a sigh of relief. And when you said this is a common transaction, I wanted to stand up and say, that's what we're talking about. You have used the most tangible form of adding value to your company that you can possibly make. You add value in lots of different ways, but man, that's the one that pays the piper.
That's a great way to look at it, John. Yeah.
Hey, Mike and Stephen, this is Tom Rogers. I just want to echo John's words of thanks. We really appreciate your efforts today and PYAs in general. We're going to try to build something special with Spark, and we appreciate you being with us on the journey.
Yeah, we're pleased to be part of it. Thanks for allowing us to be here.
Yeah, absolutely. Thanks so much.
It looks
Brandon
like there may be
Iglesias.
another question from Brandon.
There is. Brandon, do you want to jump on and ask that?
Let's see, just reading his, I'm just going to read out loud here. Let's see, follow-up question: when providing in-kind with grants, categorizing labor, assets, etc., provided are top of mind to our team, what are best practices for classifying in-kind on book and tax basis? Thank you. So, Stephen, I don't know if you want to tackle that first from a tax standpoint. I'll say from a book standpoint, it can depend on the in-kind there, and we may need to talk a little more, Brandon, offline about some of the specifics there. But if we're talking about non-cash, and I would probably have more questions and answers on that question, but let's just assume for a minute we're talking about some kind of in-kind service. Typically, if we're talking about labor, then for labor in kind, there are some rules that eliminate the ability to recognize that as revenue. But if we're talking about non-labor in kind, there are some rules that allow for the recognition of that. So it may be a pretty deep question that we'd have to spend some time knowing the specifics on to be able to answer that. Stephen, I don't know if you're able to add more.
Yeah, no, I always had a similar thought. Just generally speaking, from a tax perspective, when I hear in kind and non-cash, and my mind typically goes to like contributions. So like, what are you contributing in? And typically from a tax basis concept, you're looking at whatever, determining the fair market value of whatever that is, your services or if you're contributing appreciated property into an organization. And again, kind of like you alluded to, there can be a whole host of considerations, and questions that come along with the non-cash in kind.
So Brandon, I think the short answer is for now, it may depend, but we'd be happy to understand the specifics of that, more offline with you and help you get to the right answer on it. So.
Yeah.
Any
All right.
further questions? I think we're headed toward adjournment. Again, many thanks, Mike and Stephen, for the time that you put in your presentations and delivery this morning. Tom Ballard, thank you for being a part of it, and you all are entirely welcome to come over to Spark and see how we're doing, and maybe jump into the third and fourth workshops.
We will be, I think we are on the, which one is it? The third one or the fourth one? There's one
I
on-
think we are too. We have to go figure that one out.
Yeah, all right, all right. Well, happy holidays, Merry Christmas, all that to everybody. So look forward to seeing everybody in the new year and
Right.
literally seeing everybody in person, right?
Yeah, that'd be great, Tom.
Amen.
Would.
All right.
It would.
See you all
Thanks,
soon.
everyone.
I'll see
Thanks,
you
everybody.
shortly
Thank
in
you.
another
Thanks, everybody.
Zoom.
Bye.
Yeah.